I think that with the promise of the Fed at zero interest rates and their stimulus of the economy, the cash percentage should probably be a little bit less than 25%. And gold has been a very poor performer this year, but commodities broadly have done very, very well until May of this year, and now they're going sideways. When it comes to the stock allocation, for the first time in, I think, more than a decade, we at DoubleLine earlier this year started to allocate to European equities, part of our equity holdings. And the equity market in the United States and the equity market in Europe have been very similar for quite a while now, really since the middle of 2020. The U.S. stock market had been outperforming Europe, well, consistently and almost constantly for a decade. But starting in the middle of 2020, they're now moving in lockstep. And I think that the attractiveness of European stocks is based upon their valuation and kind of the structural aspect of the economy in Europe seems to be in sync with the growth that's going on in the globe. So we actually are now favoring European equities. It hasn't worked really for the past year and a half, but it hasn't not worked either. Well, the Federal Reserve earlier this year pretty much promised that short-term interest rates would stay at zero for at least a couple more years. And they seem to also be interested in controlling a little bit the shape of the yield curve and controlling even long-term interest rates. So the 30-year Treasury bond got up to around 2.5% earlier this year. And now it seems like it can't get above 2%, even though inflation's been increasing. And that's one of the reasons why I say I think the Fed is behind the scenes trying to manipulate interest rates lower at the long end. So they've been extending the maturity of their quantitative easing, which is $80 billion of treasuries per month and $40 billion of mortgage-backed securities. And there's some whispering behind the scenes that maybe they're going to start thinking about tapering that quantitative easing. But as long as it's going on, they keep the bond yields at a very, very low level. I mean, we have negative real interest rates that are rivaling the Jimmy Carter era of the late 70s, with the CPI on the headline at about 5.4 and on the core at about 4.3. Either way you look at it, you're at -3 or -4% real interest rates. And so what I've been talking about for most of this year is that as overvalued as stocks are relative to historical measures like the price-earnings ratio or Dr. Shiller's CAPE ratio or price to book and all that sort of stuff, as overvalued as they look by historical measures, they still are cheaper than bonds, treasury bonds. And that's one of the things that's bolstering the U.S. stock market in addition to the stimulus in the economy. So if you look at the inverse of the PE ratio, which is kind of gives you a yield on, say, the S&P 500, it's below average on its valuation versus bonds. So simply, bonds are so overvalued versus the inflation rate and versus economic growth and other measures like the copper-gold ratio, all of our typical benchmarks for treasuries that we use and have been very helpful over the years, they all suggest that on a fundamental basis, the 10-year treasury should be at least 100 basis points, if not up to 200 basis points higher than it is versus economic and inflation fundamentals. But it's not there because of the Fed's policy. And as long as the stimulus goes on, the stock market can stay in very overvalued territory. One of the things that I've been noticing for a decade now, even more than a decade, is that the stock market's market capitalization, let's just use the S&P 500. If you take that capitalization of the S&P and compare it to the size of the Fed's balance sheet, which is the consequence of their quantitative easing, which is now over $8 trillion. If you compare the capitalization of the S&P to the size of the Fed's balance sheet, it's almost a constant. And it's been that way with very little variation. It's almost like a law of physics, it feels like. Market physics anyway. And so as long as the Fed is expanding its balance sheet, there's a tailwind behind the stock market. And so I think that's one of the reasons you're going to those new highs is that the bonds are so overvalued. I've been, for about a past year plus, I started advocating a little over a year ago, kind of the construct of something that was a popular mutual fund back a decade ago called the permanent portfolio. And it's 25% cash, 25% long-term government bonds, 25% stocks, and then 25% gold. And not everybody loves gold, but it's just a placeholder for real assets. I think that with the promise of the Fed at zero interest rates and their stimulus of the economy, the cash percentage should probably be a little bit less than 25%. And gold has been a very poor performer this year, but commodities broadly have done very, very well until May of this year, and now they're going sideways. When it comes to the stock allocation, for the first time in, I think, more than a decade, we at DoubleLine earlier this year started to allocate to European equities, part of our equity holdings. And the equity market in the United States and the equity market in Europe have been very similar for quite a while now, really since the middle of 2020. The US stock market had been outperforming Europe, well, consistently and almost constantly for a decade. But starting in the middle of 2020, they're now moving in lockstep. And I think that the attractiveness of European stocks is based upon their valuation and kind of the structural aspect of the economy in Europe seems to be in sync with the growth that's going on in the globe. So we actually are now favoring European equities. It hasn't worked really for the past year and a half, but it hasn't not worked either. They have the same type of return. And since European equities are so much cheaper from a PE perspective or a Shiller-Cape ratio perspective, and the fact that we believe ultimately that these deficits from the stimulus and from the trade deficit expanding also due to stimulus, that the dollar, although we've been bullish on the dollar for the past several months, it's just a tactical move. We think in the longer run, the dollar really is going to fall fairly sharply because historically, when you run massive budget deficits and simultaneously expanding trade deficits, it's very highly correlated to dollar weakness. What we're in right now with the dollar strength appears to be a counter trend move that may be nearing its end as we move into the end of 2021. Gold has been stuck at 1,800. I think it's almost exactly 1,800 as we're speaking today. And it got up to around 2,000 and then just gave up the ghost. This is about a year ago. And now it's it's cheap when it's at 1,750 and seems like it's expensive relative to its trading range at 1,850. Meanwhile, Bitcoin has been on a wild roller coaster, but broadly speaking, it's up a lot. And I think it has to do with the way the government stimulus has been sprinkled around very, very broadly into the economy with stimulus checks going to people. And I do think that the people that receive stimulus are probably more likely to trade Bitcoin than to deal in gold. And so I do think that the stimulus has been a booster for the relative performance of cryptocurrencies. Also, it just seems that governments just seem to be becoming less and less in control of the situation. And there seems to be a sort of societal cultural theme that people believe that Bitcoin and other cryptos are a little bit outside of the government. I don't agree with that assessment, but as long as that's the mentality of investors or speculators, it can rule the day. And I think that's what's happening with Bitcoin. Bond people are very low risk people. People that want risk, it's difficult to trade in bonds if you are interested in a wild ride, because a big day in the bond market is the move of a percent, and Bitcoin can change 20% in an hour. I've seen that happen. So I give advice on Bitcoin, and I'm actually not bullish on Bitcoin. I've been wrong on Bitcoin recently, but I've been broadly bullish on Bitcoin for about 2 years. I'm just not in the short term. But Bitcoin is clearly a tool of speculation, and it's a great trading vehicle if you want a lot of action. And I think that's one of the appeals. A lot of people, when you give them $2,000 or $1,200, whatever size a certain stimulus check can be, they feel like they're playing to a certain extent with the house's money. And Bitcoin is a great vehicle for speculation, far greater, better vehicle for speculation than gold. So no, I've never been personally long or short Bitcoin. Well, the longer term consequences of U.S. policies are going to be, it's one of the reasons why I favor non-U.S. stocks, not emerging markets, even though they're super cheap. Emerging market stocks are so cheap compared to developed market stocks, but there's a reason for that cheapness. And that's the COVID problem is so much more significant in emerging markets with healthcare systems and vaccinations not available in many cases. So emerging market equities they're not even up this year. So really, I think that the places to be in the long term are going to be emerging markets and non-U.S. entities. My number one conviction looking forward a number of years, I'm not talking about the next few months at all, I'm talking about several years, is that the dollar is going to go down. And because of that, I think I've already rotated into European equities. I will rotate very aggressively into emerging market equities. I just think it's too early for that right now. So the dollar going down is another reason why ultimately we touched on gold. I think ultimately gold is going to go a lot higher, but it's really in hibernation right now. The U.S. has enjoyed the status of sole reserve currency globally for decades, and it's an incredible benefit. We also have the biggest military in the world, which is kind of goes hand in glove with being a reserve currency, I think. But in the aftermath of the lockdowns and the pandemic that continues to wear on, the strongest economy in the world by far has been the Chinese economy. And the US economy has bounced back with a lot of consumption. A lot of that consumption is going to China. It's one of the reasons China has such a strong economy. So what we're seeing is the United States is starting to fall behind in economic growth. That's not a new thing. That's been going on for a generation. The U.S. falling behind, but the Chinese economy is growing so rapidly that the estimates as to when the Chinese economy will be the largest in the world keep getting pulled forward. 20 years ago, it was thought to be 2050, the Chinese would be bigger than the U.S., and then it was 2040. And now the estimates are maybe it's in the 2020s. Maybe even 2028, the Chinese economy gets bigger. And China's made no secret of the fact that they want to be a global player and have at least a seat at the table of global reserve currency status. And they're spending like crazy on military, and have also made no secret of the fact that they want their military to be dominant, maybe the biggest in the world. Also, they have huge savings in China. They have a culture of savings. They sort of the gold medalists of saving. Historically. And so when you put all those things together with the U.S. growing debt like crazy, we have debt to GDP that is fueling the majority of our so-called economic growth. So is it really economic growth when you borrow money or print money, send checks to people who turn around and buy goods on Amazon in addition to maybe paying down debt and speculating, and these goods come in from China? So we're running our economy in a way that is almost like we're not interested in maintaining global reserve currency status or the largest military or global, call it superiority or control. And so as long as we continue to run these policies and we're running them more and more aggressively, we're not pulling back on them in any way. We are looking at a roadmap that is clearly headed towards the US dollar losing its sole reserve currency status. And I feel that as long as we run these policies, it's almost certain that that's going to happen. And because of that, the dollar should be going down. The value of the dollar is so high because we enjoy global reserve currency status, and we don't really respect it enough. We take it for granted, I guess. We seem to take a lot of things for granted these days in the United States, relative to how we thought about things in prior decades and generations. And I believe that we're setting the stage for us to, unfortunately, I use the word enjoy. I guess that's an experience, I suppose I should say, the consequences of our actions, the way we've been running a non-serious economic program now for really since 1980, but it's really accelerated so much in the past decade, and there's no signs of it abating. So that's the reason why the dollar is going to go down. And I believe the dollar is going to take out the lows of the past down cycle. See, the dollar has been in a series of declining highs for decades. It goes back to the 80s. And for that reason, I think when we get to the next break to the lower level, the dollar is going to go past the most recent low of around 80 and even take out the low of 70. So I think there's easily 25% downside in the US dollar. And with stocks so overvalued versus historical metrics, it means that, for US based investors, buying stocks in foreign currencies, right now I prefer the euro, ultimately will be emerging markets, maybe starting next year, that's going to be the place to be.